Imagine you have all your eggs in one basket. What happens if you drop the basket? You lose everything. That's what can happen if you put all your money in just one investment. Portfolio diversification is like having multiple baskets for your eggs. It means spreading your investments across different assets. This way, even if one investment performs poorly, the others can cushion the impact. Think of it like this. You wouldn't want to eat only one type of food, right? You need a balanced diet with different nutrients. Similarly, your portfolio needs a mix of different investments. This helps to reduce risk and improve your chances of earning consistent returns over time. Diversification is particularly important for investors in India. The Indian stock market is dynamic and can be volatile at times. By diversifying your portfolio, you can ride out these fluctuations and achieve your long-term financial goals. Remember, diversification is not about avoiding risk altogether. It's about managing risk effectively so that you can grow your wealth steadily over time. Diversification is your safety net in the world of investments. It's the key to mitigating risks and maximizing returns. Spread your investments across stocks, bonds, real estate, and gold. If one underperforms, others can compensate, minimizing losses. Diversification promotes smoother returns. When one sector is down, another might be up. Benefit from economic progress and potentially higher returns. Diversification offers peace of mind and security. Diversifying your portfolio isn't just about buying different stocks. It's about strategically allocating your investments across various asset classes. Sector diversification is key. Invest in sectors like technology, healthcare, and finance. Market capitalization diversification is crucial. Balance large cap, mid cap, and small cap companies. Geographic diversification reduces dependence on one economy. Use mutual funds or ETFs for global equities. Consult a financial advisor for a personalized strategy. Let's look at a real-time example of diversification within the Indian stock market. Imagine you want to build a portfolio with exposure to various sectors. You could consider investing in Reliance Industries, HDFC Bank, Infosys, Sun Pharmaceutical, and Hindustan Unilever. These companies represent different sectors of the Indian economy and offer a well-rounded exposure to the market. Reliance Industries, a conglomerate with interests in oil and gas, telecom, and retail, provides stability and growth potential. HDFC Bank, a leading private sector bank, offers exposure to the financial sector. Infosys, a global IT giant, represents the thriving technology industry. Sun Pharmaceutical, a major pharmaceutical company, provides access to the healthcare sector. Lastly, Hindustan Unilever, a consumer goods giant, offers exposure to the ever-growing consumer market. This is just a hypothetical example, and the actual stock selection should be based on thorough research and analysis. Remember, diversification is not about picking random stocks from different sectors, but selecting companies with strong fundamentals and growth potential within their respective industries. Section 5. Building your diversified portfolio. A step-by-step guide. Creating a well-diversified portfolio is a systematic process that involves understanding your financial goals, risk appetite, and investment horizon. Determine your comfort level with investment fluctuations. Are you comfortable with high-risk, high-reward investments, or do you prefer a more conservative approach? Explore different asset classes like stocks, bonds, mutual funds, ETFs, and real estate. Research and select specific investments within each asset class based on your risk tolerance and financial goals. Decide how much of your capital you want to allocate to each asset class and investment. This allocation should align with your risk tolerance and investment objectives. Periodically, review your portfolio's performance and make necessary adjustments to maintain your desired asset allocation. Rebalancing involves selling overperforming assets and buying underperforming ones to bring your portfolio back to its target allocation. Remember, diversification is an ongoing process, not a one-time event. Regularly review and adjust your portfolio to align with your changing financial situation and market conditions. Section 6. The importance of fundamental and technical analysis. While diversification is crucial, it's equally important to select the right investments within each asset class. Fundamental and technical analysis can help you make informed investment decisions. Fundamental analysis involves evaluating a company's financial health, management quality, industry position, and growth prospects. It helps you identify companies with strong underlying fundamentals that are likely to perform well over the long term. Technical analysis, on the other hand, focuses on studying price charts and trading volumes to identify patterns and trends. It can help you determine the right time to buy or sell a particular stock based on market sentiment and momentum. By combining both fundamental and technical analysis, you can make more informed investment decisions and increase your chances of selecting winning stocks for your portfolio. Remember, thorough research and analysis are essential for successful investing. Section 7. Monitoring and rebalancing. Keeping your portfolio healthy. Building a diversified portfolio is just the first step. It's equally important to monitor its performance regularly and make necessary adjustments to keep it aligned with your financial goals. Market conditions and your financial situation can change over time, impacting your portfolio's asset allocation and risk profile. Regular monitoring allows you to identify any deviations from your target allocation and take corrective actions. Rebalancing involves selling overperforming assets and buying underperforming ones to bring your portfolio back to its desired allocation. This helps you manage risk effectively and ensure that your portfolio remains aligned with your investment objectives. The frequency of monitoring and rebalancing depends on your investment strategy and risk tolerance. However, it's generally recommended to review your portfolio at least annually or whenever there are significant changes in your financial situation or market conditions. Section 8. Diversification, your key to long-term financial success. In conclusion, diversification is not just a financial strategy. It's a fundamental principle for long-term financial success. It's the key to mitigating risks, maximizing returns, and achieving your financial goals with greater confidence. By spreading your investments across various asset classes, sectors, and geographies, you create a resilient portfolio that can withstand market fluctuations and deliver consistent returns over time. Remember, diversification is not about avoiding risk altogether, but about managing it effectively to achieve your financial objectives. Embrace the power of diversification and watch your wealth grow steadily toward a brighter financial future. Section 9. Seeking expert guidance for your investment journey. While this guide provides a comprehensive overview of portfolio diversification, seeking guidance from a qualified financial advisor is always recommended. A financial advisor can help you assess your risk tolerance and financial goals, develop a personalized diversification strategy, select appropriate investments based on your needs, monitor your portfolio's performance and make necessary adjustments, and navigate complex financial markets and regulations. Remember, investing involves inherent risks, and past performance is not indicative of future results. Seeking professional advice can help you make informed decisions and achieve your financial aspirations with greater confidence. Section 10. Conclusion. Embracing diversification for a brighter financial future. In the ever-evolving world of finance, portfolio diversification stands as a beacon of stability and growth. It empowers investors to navigate market uncertainties, mitigate potential risks, and capitalize on emerging opportunities. By embracing the principles of diversification, investors, especially those in the dynamic Indian market, can pave the way for a secure and prosperous financial future. Remember, diversification is not a one-size-fits-all approach. It requires careful planning, regular monitoring, and periodic adjustments to align with your evolving financial goals and risk tolerance. By adopting a disciplined and informed approach to diversification, you can weather market storms, capitalize on growth opportunities, and achieve your long-term financial aspirations with confidence. Embrace the power of diversification and embark on your journey toward financial freedom and security.